If you're trading and there are too many indicators, conflicting signals, and confusion, this video will fix that. I've been trading for over 35 years, and my most reliable framework today uses just 2 lines on a chart. It's the box theory. When you strip away the noise and focus only on high probability zones, and this is where institutions are actually trading, your decisions get a whole lot clearer and your results get a whole lot better. Here are the tips to drawing the first box. First off, what is the box and how are we going to draw it? Let's start with using yesterday's high and low as 2 horizontal lines. These create your primary trading boundaries. These are simple visual structures that you can identify on any chart, and it doesn't need an indicator. You can additionally identify minor highs and minor lows. Here is why those levels matter psychologically. The top, or resistance, or ceiling, or supply is where the sellers are collectively stopped from moving any higher. It prohibits follow through, and these are oftentimes liquidity grab areas. The bottom, or the floor, or the support, or the demand is where buyers are collectively prevented from sending prices lower. And once again, these can be liquidity grabs because every institution watches these same obvious reference points. There is size at those price levels. In other words, lots of trades happened at that level. It represents an agreed upon value from the previous session. So think about who's losing from that level and who's winning from that level. Then we've got to think about the warehouse accumulation concept because we're thinking about big players. And what do big players or institutions do? They transfer inventory, think of the shares and the contracts they have, within these ranges. They have shares to sell or to buy. So when they're buying, they're accumulating without pushing price drastically or obviously. They're buying quietly while drawing as little attention as possible. The longer the price stays in that area, the bigger the eventual move. In other words, the longer the accumulation, the longer the move higher. Another part of this that a lot of retail traders get trapped in is called the short squeeze. Because while institutions are buying, what are retail traders usually doing? They're selling on those slight breakdowns through that floor, through that support. And when institutions are done buying, what happens is there's finally going to be a breakout. And that's where a short squeeze, when short sellers are forced to buy back those contracts or shares that they sold in a hurry, this accelerates and exaggerates the move higher. In other words, they have to close their positions in a panic. Institutions are taking advantage of that. And here's why we do not buy near the top, nor do we sell near the bottom. This is where those liquidity sweeps happen. Think about the action that precedes the short squeeze, or think about the action that precedes a tumultuous move to the downside after a supposed breakout. So let's talk about what winning traders do. They do not buy near the top, and they do not sell near the bottom. The rule when the market opens is to wait for price discovery. Find those tops and find those bottoms. Don't be the liquidity that's discovering them and getting taken advantage of. Wait for price to near the top. This is oftentimes the sell zone or resistance. It's not a buy zone. It can also be a level from which institutions are going to see a lot of buying happening and they'll sell into it. When price starts trading near or at the bottom of the range, this is not necessarily a level to short, although retail traders seeing the weakness will oftentimes think, here's the short. But then they're the liquidity that the institutions are going to be buying. Hence, traders always feel like as soon as they short, the market rallies, or as soon as they buy, the market falls. And this is because the vast majority of retail traders assume a breakout through a ceiling or a breakdown through support or a momentum level. Here's why these momentum-based moves at the top are so dangerous for buyers. What is driving it? FOMO, fear of missing out. So retail traders start to chase strength because they think the breakout's never going to come back down. But in fact, Wall Street is counting on this, and financial media celebrates every new high, not high probability entry points. Retail traders are providing the exit liquidity for institutions. In other words, institutions are selling, the retail traders are buying, and when institutions who have the larger amount of size are no longer active, who are these fresh, new retail traders going to sell to? Right, nobody. Hence the market rolls over. So remember, strength is actually most often institutions selling, and that is what we want to participate in. So that brings us to the bottom of the box. Here's why the bottom is dangerous for sellers, chasing momentum once again. Panic sellers dump positions at the worst time. The smart money, the big money, the institutions are accumulating or buying that now at this discounted price. Avoiding the extremes of the box, presuming every breakout is an opportunity to buy and presuming every short is an opportunity to take advantage of lower lows. By avoiding those extremes, retail traders can now prevent becoming the counterparty to the big players. Now will play the same direction they're playing. Patient traders know to wait for their levels and zones, and they don't trade in the middle. So draw the center line and avoid that zone. Mark the 50% of every box. Stay out of trading, especially the first 10 to 15 minutes after the opening bell. During that time, create a visual no trade area. This can be time. Some traders like to wait till at least 9:35 or 9:45. Other traders will wait till 10 a.m. Eastern to get these levels identified before engaging in any trades. And here's why. The middle destroys accuracy. It's too far from the premium buyers, and the sellers are equally uninterested. The market will flip-flop. So equal probability of moving in either direction does not offer a statistical edge or follow-through. It's balanced, it's equilibrium. Remember that follow-through is imbalance, and that is what we're looking for. The bulls can be right or the bears can be right, but smart traders wait to see who has control. And that leads traders to tackling the gambling problem. Price movements without a statistical edge, trading away from the box, really are random fluctuations. Risk-reward ratios for smart traders are typically going to be 1-to-1, not the fanciful 4-to-1 or 10-to-1 we hear about. In the real world, risk 1 to make 1, or risk 1 to maybe make 1.5. We wait then for edges of high probability. These are levels that actually favor follow-through because remember, no trader is right alone. We always need at some point the herd to participate. So if we're trading with institutions, they're counting on the herd as the counterparty. Trade with the institutions, not the herd. And that's where the follow-through will be best. Now that might sound really simple, but here's why most strategies get this completely backwards. The traditional approach teaches, frankly, the wrong entry points. Traders are taught to buy strength and sell into weakness. And it sounds logical, right? It sounds like sound advice, like buying high and selling higher. But here's why that's the problem. By selling into lower lows, more often than not, and especially in chop, that's going to be the liquidity grab. Institutions will be buying at a discount. The same goes for breakouts through resistance. The problem is, in chop specifically, institutions will be selling into what looks like a breakout, but in reality, the market's going to roll right back over and trade within the chop. So does momentum trading actually work, you might be wondering? In trends, if the market is already marching with higher highs and higher lows, these breakouts do have a higher probability of follow through. And if there's a downtrend, which is lower lows and lower highs, again, shorting near the lows does have a better probability of follow through. But here's the problem. The risk reward is terrible. But I've got a fix. We want to remember to always follow trends. Ultimately, when traders trade in chop, they're assuming breakouts are going to continue, like trending behavior. So the step that we all need to take is to differentiate chop from trends. In trends, momentum can work, but it fails in chop, or it fails in these ranges. Here's why that happens. Trending markets have attention. It might be news, it might be data, or it just might be an overwhelming number of buyers and very few sellers, and therefore higher highs are persistent. But if there's no trend, the chop then creates a trap for traders who are presuming every breakout to a new high means new higher highs. The fact is, the market spends the majority of time ranging, not trending. So here's the fix. Use simple tools. If a box occurs in a wide range, it is very likely going to remain in that box. If a box is a narrow range, it has a higher probability of breaking out and continuing for at least 2 times the width of the box. But without separating trend from chop, traders are looking for misery. Because here's why chop, or range-bound markets, are an account killer for most retail traders. They don't know how to identify chop in real time. By drawing the boxes, we can identify the chop, and we can use simple tools like a slow stochastic to identify where the chop is actually overbought or at resistance, or oversold and at support. So combine the box with a slow stochastic, and you've got a great simple approach to identifying range-bound behavior when the probability is that price action will stay within that support and resistance. Now remember, support and resistance could also be considered a floor and ceiling. A support and resistance level could also be considered supply and demand. It's just lingo. So here's what's happening when you finally do see strength. Institutions are pushing price to trigger stop losses. In other words, the market moves in the direction of the most stops. If volume is surging at a choppy resistance level, chances are institutions are selling their position, they're transferring their position to retail traders, and then the market will fall right back into the range. Retail traders are almost virtually expected to chase that momentum, and banks and funds, these institutions, they know it. So retail chases momentum, frankly, at the worst possible but most predictable moment. And here's why the box theory flips that logic. We've identified boxes throughout the morning. We can sell near a ceiling, like the institutions do, and we can buy near the floor, like the institutions do. And in chop, this works amazingly well. So that means we wait for extremes with the actual edge. We avoid being that exit liquidity for professional traders or for institutions and hedge funds, counting on retail traders always assuming the breakout. That brings us to secondary boxes, because it isn't just about one box for the trading session. Here's how to identify and draw a secondary box. Take any clear high or low pivot during the session. This is where price turned abruptly, maybe leaving a hanging wick, a doji, or an inside candle. Box that in with the 2 lines using the same process. You're going to use the same methodology to draw multiple boxes throughout the trading day, finding those turning points, realizing that's where the liquidity grab happened, and creating a box in that zone. Now, there's a cool thing that happens, and this is understanding the nested structure concept. You could have a primary box. It could be a large range that was established during the first 30 minutes after the bell, or maybe the first hour after the bell. This could be the clearing range box or the initial balance box. Think of this as the big picture. By waiting for the high to low range to be established between 9:30 and 10 o'clock Eastern, or 9:30 and 10:30 Eastern, we can draw this big picture box. Here come the secondary boxes. These are oftentimes smaller ranges within that wider original box we drew based on time. Oftentimes, midday doldrums between 11:30 a.m. Eastern and 1:30 p.m. Eastern is where you'll see narrower, what they call lunchtime or midday doldrum boxes occur because volatility and volume tend to drop on the East Coast during these times. These levels are often reacted to throughout the trading session. And then, of course, we're going to reset this whole process for the very next day. Now, here's a tip. Traders can also look to the Asian session highs and lows between 8 p.m. Eastern and midnight. There are also European session boxes that can occur between 2 a.m. and 4 a.m. Eastern. Remember, we trade in a global community, and if you are trading gold, the S&P, if you're trading silver or the NASDAQ, these pre-market boxes can be very helpful to understand the structure of where the selling and the buying has already occurred and where those reaction zones may be as we enter the US session. So at this point, you've got secondary boxes and a primary box. And now we want to check alignment for probability. So if secondary boxes are going to give us support and resistance within a primary box, this can often be a little bit of a heads up to an ultimate breakout. So if there's a narrow box occurring in a wider box, the narrow box can be perhaps a momentum breakout that will exhaust at the primary box boundaries. Now here's another tip. Always confirm the structure, whether that be the primary box or especially the smaller secondary boxes. They need to be supported by the overall directional bias of the session. And you might ask, how do I know what that is, Raghee? It's really easy. Here's what it is. It's the previous session's close. So if we're trading boxes on a Tuesday, Monday, 4 p.m. Eastern is the previous session close. It's the close of the session that last completed. I call it the PSC. Alignment with the previous session close, or the PSC, increases the win rate dramatically. Here's how you would use it. If you're looking for a box breakout and price action is below the previous session close, it's a low probability setup. However, if there's a breakout or even a buy off support that's occurring above the previous session close, it is a far higher probability setup. In other words, buy price action when it's above the previous session close and at box support, and short price action when it's below the previous session close and at box resistance. This is what brings us to liquidity sweeps versus true breakouts. So what a false breakout now looks like, you know. It looks like something that a momentum trader would chase higher, and institutions are actually using, soaking up all that buying liquidity to sell. They are selling their positions to retail traders who oftentimes sadly think price action is going to keep going. And that is what a false breakout looks like. Think of it this way. The only reason price continues to go higher is that a new group of traders are willing to pay a higher price. So as price, for example, breaks $100 a share, the only reason it goes to 105 is that along the way, other traders were willing to buy 101, 102, 103. You need traders willing to keep coming in and buying at higher highs. That is less likely in chop and more likely in a trend. When price spends very little time outside the box, it's not establishing higher highs or higher lows, it's probably going to be a false breakout. Price finds a boundary, no buyers want to buy at that higher high, price gets rejected quickly, and like a rubber band, it snaps back to the center of the box range. But here's what true breakouts look like. Price moves outside the box. You look to the previous session close to make sure the confirmation is there. When we are above the previous session close and price is trading through the upper end of the box, there's a high probability of a momentum follow through. However, smart traders now know after watching this video that the best place to position yourself is at the support level. And that way the ride across the box up to resistance can oftentimes be a first target rather than the first entry. However, if the box is broken, remember, the old ceiling becomes the new floor, or what was once support becomes resistance. It's role reversal. Participants are now accepting that new price as fair value, and there are enough orders at that price to support a retest, which is the opposite of what a false breakout looks like. At this point, the rubber band is broken. It's snapped in half and the tension is gone. And this will happen most often in trends. So here's the waiting rule for confirmation to avoid those false breakouts or whipsaws. Don't enter immediately when price touches the ranges of the box. Wait for multiple closes, oftentimes retests beyond that boundary, and especially wait to see if there's a trend. Even better, once you get the retest of that old level, confirm the trend and then wait for a retracement, oftentimes to the middle of the box. This is referred to as a halfback or a 50% retest. So if you have a box that has a midline, that will now be support if there is a true breakout. Patience prevents getting trapped in these fake moves, and even more so, patient traders are entering at better risk reward levels, which again would be buying at the support of the box or even a retest of the middle of the box after a breakout. There's a lot to digest here, so you might want to watch this video a few times. Here's your quick recap though. Mark yesterday's high and low. Don't buy at the top and don't sell near the bottom. Separate range-bound or choppy markets from trending markets. If the market is chopping, use a slow stochastic. If a market is trending, if there is a breakout, wait for a retest of the top of the box or a 50%, the middle of the range, buying opportunity. In chop, avoid the middle where there's no edge. In a trend, this could be a great conservative entry. We also know we need to draw secondary boxes. Secondary boxes can be the pre-market Asian and European sessions, or even the lunchtime doldrums. And check where those boxes are sitting in relation to the primary box that was drawn between 9:30 and 10 or 9:30 and 10:30. If all of this is happening in a non-trending environment, be cautious. But if we have a trend, that's going to be excellent confirmation for follow-through. Over time, traders who enter at the edges, support for buys, resistance for shorts, with great risk-reward ratios, will outperform those who chase the breakouts or who are waiting for follow-through in chop. If you want to work on this live with me in my trading community, the details are below. We look at these boxes, these ranges, every single morning. I'll guide you through real setups and psychological traps that oftentimes market players like institutions will play on you, and heck, that you can play on yourself. I'll teach you how to build consistent execution rules and follow that process. Thanks for watching.